If we look at the all shares performance over 4 years on a total return basis, it's been less than that 6% inflation per annum. And Naspers has been half of that return. So if you strip out Naspers, and very few investors have had full allocation to Naspers over this period, we haven't kept pace with inflation. And if we were a dollar investor in the South African all share, we've had negative returns. If, on the other hand, we'd been invested in the US stock market and something like the Standard & Poor's, we've had 11% dollar returns for 4 years and 19% rand returns. So looking in the rearview mirror, the obvious thing is we shouldn't have been in South Africa, we should have been in the US. So where are we today? And what we will suggest is that from the starting point that we see right now, look in the rearview mirror probably won't help you. We think you need to be looking forward. And the way valuations are situated, particularly domestically, we think there is some stuff to be excited about. If we look at how South Africa's fared for a US investor, and we look at the MSCI South Africa, when expressed in dollar terms, you've had no return for 10 years. So foreign investors are not in love with South Africa. But there was a heralding of a new dawn in December of last year, and prices rose, and they've subsequently collapsed. And it's absolutely amazing to us that some of the stocks we look at, quite a few of the stocks we look at, are cheaper than where they were in November of last year. And we think it's quite a stretch to suggest that South Africa today is in a worse place than where it was in November of last year. But two things have happened. The first is during the course of 2018, we've had a significant sell-off in emerging markets. That little down red arrow has coincided with aggressive selling of emerging markets by foreign investors. In the space of 2 months, $20 billion was redeemed from emerging market funds. If we look at one fund on its own, which is the BlackRock iShares Emerging Markets Fund, it lost $9 billion over that period. And if we say how much of that would have been South African stocks, just based on the MSCI weighting, that would have been 7.5 billion rands worth of South African stocks that had to be sold because foreign investors decided to downweight emerging markets. And the point I'm making is that financial assets in South Africa are very much at the mercy of foreign investors, and in particular some of these passive flows that kind of chase what's hot and then roll out. So we've had an emerging market sell-off, but we've also had a complete lack of confidence domestically. And this is a really good chart because it shows you business confidence over the last 40 years. And you can see these very pronounced cycles. You can see we've been in dark spaces before. The Rubicon era in the 80s, Chris Hani era in the 90s, the Asian financial crisis in the 90s, and then the GFC in 2008. But you clearly can notice that we've essentially been in the doldrums, banging around in a low confidence type environment for a decade. It's like a lost decade. But if you drill into some of the indicators, the key indicators of the economy, for us, they're unequivocally suggesting bottom of the cycle type numbers. So you can look at gross fixed capital formation as a percentage of GDP. You can look at inventory levels. You can look at bank advances, growth in bank advances. You can look at the quality of banks' balance sheets, etc. They all speak to an environment that is very, very indicative of bottom of the cycle and a long, long way from anything that's close to a normal cycle. So we say under any kind of normal conditions, we should expect things to pick up from here. But importantly, when people are as pessimistic as they are right now, and you've had this kind of confidence for such a long period, plus you've had the foreigners selling, an opportunity arises. And that is an opportunity to buy assets that are priced that South Africa is never going to grow again. And we refer to that as essentially a free option. Even if South Africa carries on muddling along, we think a number of the stocks we own, some of the bonds we own are actually going to do nicely. And if by any chance we do get this long-awaited pickup in confidence, this long-awaited pickup in the cycle, returns should be very strong. So we own a basket of stocks that trade at less than 11 times earnings, domestically facing stocks. And what we've been doing is we've been quietly acquiring a number of at least average quality businesses, but in some cases we think well above average quality businesses, but at substantially discounted prices.